Have you noticed all the volatility that's happening in the markets? I mean, oil up 40 bucks, then down 40 bucks. Gold up 40 bucks, then down 40 bucks or 50 bucks or whatever that number is. Markets up and then they're crashing. So, why is there so much volatility going on, and what does that mean? Well, I think I know, and that's what we're going to talk about coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer specializing in custom strategies. But you know what? These strategies are really based upon repeatable patterns. And one of the repeatable patterns we know is if you give bankers the task of doing something, particularly when you give them the control of it, well, there are going to be a few at the top that win and many at the bottom that don't. I'm going to show you what's really happening in these markets, because what it really is the same pattern that we see. The markets are breaking down. And when you give central banks that ability, because it really did all start when we were completely removed from the gold standard. So let's take a look at that and how you can protect yourself. Because what we're going to talk about today is the financialization of all assets. Or in other words, how to take something that's real and turn it into something that's unreal. How many times do I get the question about, why, if everybody's buying gold and silver, why are gold and silver markets going down? Well, it's the spot market. It's a contract market. And this is the start of the contracts. Because really the future contracts, futures, these are derivatives, started in 1959. Now, there were just a few, things like, soybeans, wheat, things like that, those contracts. Now, there can be a legitimate use for a futures contract. If I grow wheat and it's January and I'm not going to harvest until August and I need to ensure a profit, well, okay, I can buy a futures contract that locks in or guarantees me a price in the future, presuming that that exchange is still in existence, like we recently saw with LME, the London's Metal Exchange. We'll see what happens with that. I'll talk about more of that more on another day. But there are some legitimate reasons to have the futures market. But here's the commodities in metals, which I found really interesting. And let's talk first about silver. Everybody always wants to know about silver. Okay, well, I find it quite interesting that the spot contract on silver, which enables the markets to believe that there's a whole lot more silver in the world that exists and actually does exist. That started in 1963, and the Silver Coinage Act, where they removed silver from the coin contact, that was passed in 1965. And what did President Johnson threaten? That anybody that attempted to hoard silver, they would destroy them. Here is our president admitting to manipulating the markets, and somehow, magically, that was okay. I mean, a lot of things that have happened, it's amazing to me that they're okay. But when they created the gold futures, that was 1974. After they took us off the gold standard. And really what they did was they handed the full control of inflation to bankers, private bankers. And the creation of these contracts to control physical goods with paper contracts, finite amount, infinite amount in paper contracts. They exploded after 1971. Once they did all of that with real assets, well, global health has been financialized. Used to be, you went to your doctor, you had one doctor, maybe he was the doctor that when you were born, maybe he delivered all of your, or she delivered all of your babies. But today, all of those doctors, or most of them, have been bought up and been put into conglomerates, and they've been sold as they've been then turned into contracts and sold, financialized. And how many choices do we have? And can you just go see your doctor if you have insurance? No, I don't think you can do that. You have to get approval. They have to get recommendations. The care has gone down and the costs have gone up. We'll talk more about that. The ongoing financialization of global health raises new questions of governance, which we expect to affect policymakers as much as doctors, nurses, and patients in the years to come. Policymakers, right? Policymakers like in the government and in the central banks, because certainly even the pharmaceuticals have been well financialized. The increasing influence of the financial sector on the industry, including changing patterns of shareholder ownership, the importance attached to the idea of maximizing shareholder value, the pay and share options given to company chief executives and other senior managers, the use of share buybacks, the increase in the outsourcing of manufacturing and of research and development, along with the growing use of mergers and acquisitions and of new forms of borrowing. New forms, this is called financial innovation, of borrowing to fund them. So those that have access to cheap funding, they borrow, they create this, then they pass that risk on to you. They are turned into financial products and sold to you. So at the end of the day, they're getting paid and you're taking the risk. I don't know. Does that sound fair to you? Sounds great to me. Because the highlights are, interestingly enough, increased in the pharmaceutical industry since 1980. Maximizing shareholder value is a key concern for pharmaceutical companies. What about the health of the patient? All right, we'll look at that in a second. Neoliberal economic policies support and protect the pharmaceutical industry. Do they not grant waivers so that they are not held liable? Have we not just experienced that quite a bit? Yes, they are. They are granted anonymity. They are held harmless for any harm that they do. Not any. There are certainly some lawsuits, but there are workarounds. And who's really paying for that? Is it really the pharmaceutical company or the general stockholders? And financialization has pushed executive pay and drug prices way, way up. Because now that everything is financialized, it is profit over patience. And we are paying for the financialization in our medical care, in our drug care. Here's a couple of examples. I love this. Eli Lilly's diabetes medication earned the company over $9 billion. The same year, they spent $6.5 billion on payments to shareholders in the form of buybacks and dividends combined. I think that's kind of interesting, don't you? Rather than reducing the price of the drugs, the diabetes medication that so many more people need because there's so many more people that are suffering from this chronic disease. So the drug companies are profiting from it at our cost. AbbVie's pretty much the same way. Best-selling drug, Humira, earned the company $19.9 billion in revenue, also in 2018. The same year, AbbVie spent $18.1 billion to reward shareholders in the form of buybacks and dividends. 91% of the profits made were distributed. And let me kind of put this a little bit into perspective. What do you think? I mean, we've just experienced a lot of funding for these pharmaceutical companies, have we not? And what do you think would happen if any of them get into trouble? Well, the money's not left in the company. Shareholders will bail them out. Are they deemed too important and too big to fail? They certainly are a huge lobbying group, as we well know. So despite Big Pharma's claim that high-cost medicines are the price society must pay for innovation, recent research provides ample evidence that overpriced medicines are not necessary for the industry to find cures or revolutionize. I leave that to you. Global health is increasingly reliant on financial markets. Do you really think that financial markets give a crap about your health? I don't think so. I think financial markets care about shareholders up at the top, not at the bottom, but up at the top. And what about real estate? Can you imagine how expensive? I mean, look at how much real estate has gone up. Is that truly supply and demand, or is it because it was financialized? Because interestingly enough, the final financialization of the real estate sector happened not that long ago, 2016, when the S&P gave it its own financial sector. Up to that point, it was in with the banks, with the financial sector. And it became the 11th GICS sector. What does that mean? Well, all equity real estate investment trusts, REITs, and real estate management and development companies will shift into the newly formed sector, while mortgage REITs, debt, will remain in the financial sector. And what all of that gobbledygook really means is that the addition of real estate as a GICS sector will raise its profile as a distinct market segment and make its performance more explicit for investors. Who do they care about? Do they care whether or not you're out on the street? No. But hey, how about all those commercials? Change your location, change your life, all of that garbage. Because a home, everybody needs shelter. It's a part of the mantra, right? Food, water, energy security, barterability, wealth preservation, community, and shelter. You got to have a roof over your head. But there are more and more homeless because the markets don't give a crap about the homeless. Because real estate, houses, are not about shelter anymore. They're about investors, and they're about investors making money. So they've taken this physical asset and they've converted it into an intangible. And I might just remind you that one of the goals, as stated in the IMF, is to have the title for everything on a token, and then broken down into itty-bitty pieces so you're inspired to buy that blouse or that jacket. Well, hey, you got your equity on your phone. It's just a little bit. It's not going to matter. But then ultimately what ends up happening is you end up spending any of the equity that you have in your house or anything else. And that's why the World Economic Forum says you will own nothing and you will be happy. I don't think you'll be happy, but you may end up owning nothing. To repeat. So global real estate and global health is now reliant on the financial markets. It's probably not a good place to be. Because real estate represents 60% of the value of all global assets. 60%. And it's also 30% of the global GDP. It's a very important sector that is now under the control of Wall Street and their ilk. I believe there is a huge difference between housing as a commodity, because that's the way it's treated, as a commodity, and gold as a commodity. Gold is not a human right, housing is. But what gold will do is it'll make sure you can maintain your housing and your real estate and your wealth and your purchasing power. And how the financialization of housing is physically changing cities, because the increasing investment value of real estate has led to tangible changes in the way that buildings are designed and function, with a lot of them just being about making money, not for somebody to live in. Does that really make sense to you? With all the people that we have, unfortunately, homeless, and I think that problem is going to get a whole lot worse. A whole lot worse. But everything has been turned into a financial product and then sold to you. And what they're really selling you, what you're really paying for, is the risk. They get all the profits, they get ongoing fees, and you get the risk of student loans, auto loans, consumer loans, revolving credit, so credit card loans. Because all of these debt contracts are also turned into financial products. So first they do the physical, and then they also do the contracts, derivatives. This is really why you see the markets going crazy, because it's all based on collateral, it's all based on interest rates, it's all based on cheap and free money. And that may be shifting. I'm not saying for sure, because I don't think they can really do it. But non-revolving consumer loans, REITs, commercial mortgages, asset-backed securities. And by the way, an asset-backed security, I guess the term asset can be used in many different ways. But what do they do with any of these things? Those that are in position, so closest to the central bank, so other banks, other non-bank financial firms, etc., they go out into the markets and they borrow the money to create these products, and then they sell these products back to you. What skin do they have in the game? None. You have all the skin in the game. So who's benefited the most from all this financialization? Well, corporates. Look at these profits. Woo! Did you profit that much this year? And I just want to note to you that these little gray pieces here, lines, those represent official recessions. And what do you notice, especially after 2000, that when we hit a recession, well, what happens? QE, right? Money printing from the Fed, which means that the currency that's out there loses its value, or loses more value till there's no value remaining. But it sure makes corporate profits look good, doesn't it? What you're looking at here is the Wilshire 5,000, so 5,000 stocks, to all the money, the GDP, all the money that flows through the system. And you're also witnessing my little security, one of my pieces of security. Okay, Oliver. So you can see how the markets have been all turned into a financial product, because this goes back to 1971. And this right here is the average, the mean rather. Oops, sorry, forgot my pointer. All right, so this is the mean of all of the stocks to the GDP ratio. And up until, the shift really started in the early 80s, but the financialization, converting hard assets into financial products, remember, that started in 1959. There were a few that were converted, and then over time, once the central banks took over, then it took off in earnest in the 80s, really. And you can see how we bottomed here and have been moving up. So by 2000, the markets were severely overvalued and they crashed. They went up a little bit. There's 2007 and they crashed. Now look at how much higher we are today. This is this is going to be the mother of all crashes. Now, I'm not even saying that it can't do a blow off top or melt up, because as the currency loses more and more value and people have been trained, no, don't buy this or don't buy this. God, why would you want that? You want these pieces of paper, these not even pieces of paper, these digits in an accounting system. Do you trust Wall Street? Because it should be pretty clear that Wall Street is all about Wall Street, not about Main Street. And this is really how they have transitioned it to serve better the few than the many. Because it's the many that have benefited the least. And it becomes so clear when you take a look at this gap between productivity, right? So corporations are making more money as well because they're producing more. And also inflation goes into that. There's so many things that go into this to mask it, but even so you can see. Productivity between 48 and 73. Workers, the average hourly worker. If the company did better, the worker did better. But in 1973, there was a shift. Well, let's see, was there another shift in 1970? Yes, we know. We went off the gold standard and central banks took full control of inflation. I remember when they created this system to begin with, corporations wanted to have the ability to pay their workers less and less. But hey, if you're getting $10 an hour, you're not going to accept $5. But if you could make that $10 spend like $5 with the rest of it going to the top, well, then they have succeeded. So that was part of the plan right out of the chute with the fiat money system, this government debt-based system. And you can see, even now, with wages rising the fastest that they have since God knows when, but they're still not rising fast enough to keep pace with inflation. But hey, corporate profits are, you saw that. Corporate profits are doing great. It's not going to save this market, though, because it's built on a house of cards and a lie. Between 73 and 16, while productivity rose 73.7%, hourly compensation only rose 12.3%. In 1971, a family of four could live on one wage earner making $9,500 a year. Today, one wage earner making $58,000 a year, and you're paycheck to paycheck, two wage earners to support a family of four, and you're still paycheck to paycheck. And hey, they gave you a stimulus check if you made less than $150,000 a year. A lot of that has to do with the value, the purchasing power value of the government money. Not a good thing. So it should be pretty clear that financialization by design, just like the whole monetary, the fiat money system, by design, favors the few and hurts the many. And now it's coming to pass. This is why you see the extreme volatility that we're seeing in the markets, because these markets are supported by more and more money printing, more and more debt, and the Fed is between, all central bankers are between a rock and a hard place, because inflation is also rearing its ugly head. Shocker. Actually, if they can keep it at 2%, not like it hasn't been happening, but if they can keep it low enough that you don't notice, you don't scream about it, well, people are starting to scream. And frankly, when people are hungry and hopeless, they make different choices. But back to the markets and why there's so much volatility. And can you please tell me, with all the trillions and trillions and trillions and trillions that has been created just since 2008, why are we having liquidity issues? Which we are. That's what this is all about, liquidity. There's not enough collateral. Several gauges are showing deterioration. And challenges could rise when the Fed starts shrinking its bond portfolio. In other words, selling the bonds. Or not even selling them, just not buying new ones when the ones that they have now mature. They're between a rock and a hard place. They will raise rates. I'm not saying they won't do it. We'll probably, I'm sorry, I'm recording this before the Fed choice, but, they're probably going to do 0.25% tomorrow. And maybe if they do 7 this year, which I don't think so, but maybe if they do, it still won't do anything to curtail inflation because that inflation genie is out of the bottle. And more people are losing confidence. That's why they can't. Once it's out of the bottle, it cannot go back in again. This is an indication by every count of the end of this currency experiment. It's at the end. We got to transition. We have to reset the entire global economy. Socially, well, according to the World Economic Forum anyway, socially, economically, and financially. And that's why you need food, water, energy security, barterability, wealth preservation, community, and shelter. These are all the things that you need to be as independent and self-sufficient as possible as we continue through this. Because quite honestly, what choices do they have? We're already anchored at zero. Can they? And they're talking about raising rates. Can they turn around and lower rates? They probably will, to be perfectly honest with you. But it's not going to help. And they can't lower them enough. And also, we saw what happened with the negative rate experiment. It didn't really work very well. So you've got, well, let me go back here for one more second before I move on. But you've got apparent weakness and real weakness, not just apparent, but real weakness in this financialized system. And the treasuries, keep in mind, is the foundation of this entire global market system. That's why you gotta have this. That's why you have to. You really, I mean, you can do whatever you want, but anything other than gold and silver physical is just not going to help you the way you think that it is. We can see that the patient is already weak. Now, what's happening with Russia and the potential default, because we know we are all incestuously interconnected, could indeed give the death knell. International Monetary Fund Managing Director, blah, blah, blah. The Russian sovereign debt default is no longer an improbable event. Well, guess what? If Russia defaults on that bond, that means that the corporations will also default. Whoever they owed the money to, the bond money to, is also likely to default. And let's see, where are those things being held? Oh, money markets, mutual funds, ETFs, all those ESG funds. So whether you realize whether or not you own it and you think, well, that's over there and this is here. No, this is here too, because we are all globally interconnected. And they're about to default. And actually tomorrow's the day. But again, I'm recording this, so we'll see. But the likelihood of them defaulting on this debt is pretty good. And how long it takes to reverberate through and you notice it, probably, I don't know, a week, 2, 3. We'll have to keep our eye on it because it looks like this default, there's no choice. They can't pay in rubles, and Russia has declared that they cannot use dollars to make the payment. So and all of this financialization where all of these contracts are traded all around the world. That's what enables all of the contagion to go through the entire system. This just came out this morning, and I thought it was super interesting because the Ides of March, so this March, so far, this is 2022, is the 4th worst ever. But what did they do in 1935? Well, they did QE. They printed a whole lot more money and pushed it into the system. Same thing they did in 2020. Same thing they did in 2029. But going into this, because of everything that we did in 2009 onwards, 2008 really onwards, now we're going into this in quantitative tightening. They can't do it. They can't inflate their way out of this mess. It's done. So if you're not ready, I'm going to strongly encourage you to get ready, because things are about to get a whole lot worse. And when that happens, you want to be in the most liquid, most safe position that you can be. This is the liquidity pyramid, and I think you can see silver and gold right there. They are the most liquid and safest things that you can do. They don't have to pay you interest. Don't pay me interest. My bank account isn't paying me interest, but that's all risk. This doesn't have to pay me interest. I'm happy to hold it because this is my safety, and it's your safety too. It's just a fact. It's just a fact. It's why I'm doing what I'm doing. Because the world's wealthy, they're running to the safety of gold. And dynastic wealth, proven wealth that lasts at least 300 years. 3 legs. Real estate, rare collectibles, and gold. And arguably, well, you could do all 3 with gold, because you can own a gold mine and you can own a gold rare antique as well as the coins. But also, this is what enables you to accumulate the other 2. And that's really where we need to be right now. Food, water, energy, security, barterability, which is silver for me, wealth preservation and growth, which is gold to me, community, which is probably and arguably the most important part of this, and shelter. Don't allow them to entice you to spend your wealth by keeping it in intangible assets that are going away. Because if you can only convert them into dollars or euros or yen, wherever you are in the world, when those lose all value, what do you have? Trillion times 0 is 0. On my next Beyond Gold and Silver, the guest will be security experts Sean Connolly and Curtis Teets, and that will be out tomorrow on the Beyond Gold and Silver channel. And if you like this, please give us a thumbs up. Make sure you leave a comment. And even more important, frankly, share, share, share. Everybody needs to know what's going on, because everybody needs to protect themselves. And it's not just your financial future, it's your future period. So until next we meet, please, please be safe out there. Bye-bye.